Welcome to another episode of Good Value by Antipodes.
Global equities continue to push higher, driven by a resurgence in US stocks. The US economy remains resilient, but is there a tension building under the surface? Fiscal policy is front and centre once again with Trump's One Big Beautiful Bill, which promises more tax cuts and spending, while the fiscal deficit is already sitting at around 6% of GDP. Can America keep fueling growth with more spending, or are we entering into a more complex and potentially riskier macro environment? Joining me today is Antipodes Portfolio Manager Graham Hay. We're going to dig into US fiscal sustainability, what the equity and bond markets are telling us, and how we're positioning our portfolios in this shifting landscape. Welcome back to the podcast, Graham.
Thanks, Alison.
Okay, Graham, let's just get straight into it. Is the US addicted to deficit spending?
Well, the US has had a very significant fiscal impulse under both the first Trump administration and then succeeded by the Biden administrations. This latest spending and tax bill, the One Big Beautiful Bill, as you point out, delivers on many of the campaign policies that he talked about, particularly around tax cuts. Firstly, it makes the tax cuts under Trump 1.0 permanent, as well as introducing new tax cuts like tax breaks on tips and overtime, as well as boosting deficit spending and tightening border control. And the bill follows a period of exceptional spending already. From 2016 to 24, for example, the US ran a cumulative deficit of almost 60% of GDP. That's more than double the ratios that we saw in Europe and China over the same period of time, for example. So stimulus has definitely protected the US economy, and it's continued to be a tailwind of stimulus. It certainly will have a role to play in continuing to drive US growth.
How important is this bill for the US to maintain its exceptionalism?
Well, yes, the answer is very. Consumption, it's a consumption-centric economy. Consumption accounts for about 70% of GDP in America. So the most important driver of real growth is very much incomes, which include wages and transfer payments and savings. And both wage growth and saving rates are normalizing. The savings rate is rising as households are worried about job security. It's currently around about 5%. However, the long-term average is closer to 7%. So we could certainly see the savings rate increase following that depletion that followed the COVID boom. So that's certainly to be expected. On top of that, you have a labour market that's also normalizing. COVID caused significant disruptions in the labour market. We had the so-called Great Resignation, and then a skills mismatch which saw the labour market tighten significantly, and that led to strong wage inflation, even though job vacancies were quite high. The labour market has now come back into balance. The payroll data still looks good, and it's been supported by the public sector, but policy uncertainty is weighing on business confidence and investment. Real-time measures show a drop in the job openings, and growth in real wages has dropped back to 1.5% to 2% from 4% a year ago, and the long-term average is around 1%. So today we're in a low firing but also low hiring environment. Any cooling from here could see a pickup in the unemployment rate and a self-feeding down cycle in growth. In this context, the bill and its policies that support the household are important for growth, especially when we take tariffs into consideration. It's going to take time for the full impact of the tariffs to be felt, but an effective tariff of 15% could add just over 1% to core inflation. And companies like Walmart and others in that sector have already talked about the fact that if tariffs remain in place, prices will clearly need to rise. On top of that, independent research estimates the tariff could reduce real incomes by 1.7% for the median US household. And lower income families will obviously be even harder hit.
Let's dig into the funding side. The US is already running a deficit of 6% of GDP, which is a pretty significant deficit given the economy is operating at full employment. So how will Trump 2.0 fund this kind of fiscal expansion?
The bill proposes front-loaded tax cuts and spending increases without credible long-term offsets. The most notable is stricter conditions on federal health programs like Medicaid, which support the elderly, disabled, and low-income Americans. The most important of the spending cuts are delayed until after 2028, beyond the next election cycle. Supporters of the bill argue this will stimulate growth and it can pay for itself. However, independent estimates suggest the bill on its own would push the fiscal deficit to above 7% of GDP in 2026. as the full impact of the tax cuts are felt. There could be some offsets to this. The US, for example, will see some additional revenue from tariffs. This is still our best estimate until tariffs are finalised, but if we stick with that 15% effective tariff, this could add revenue of around 1% of GDP, which could keep the deficit in the 6% range over the medium term. The US Congressional Budget Office has forecast that the bill will add around $3.3 trillion to the deficit over the next 10 years, and that would take government debt from around 100% of GDP to 125%.
In terms of the market reaction, equities have surged ahead since the bill was announced and then ultimately signed earlier in the month. And the bond market did have a brief wobble, but it hasn't registered any meaningful panic. Are you surprised, given the potential for a meaningful build-up in the debt?
Well, big deficits ideally need cheap financing. The cost to service government debt is already approaching 4% of GDP and will increase as both the debt and rates rise. Concerns around fiscal sustainability do have the potential to push long-term yields higher as investors demand more compensation for holding government debt, particularly from highly indebted issuers. So following the reaction of the bond market is going to be very important. The bill will increase the call on domestic and foreign savings at a time when some of the world's largest savers are expanding their own deficits and hedging or reducing holdings of US assets. It takes a long time for foreign pension funds and foreign banks who buy a lot of treasuries to pivot away from this asset class, but at some point, those that are lending want to be appropriately compensated for this risk. And I think it's interesting that on an FX hedge basis, it is more attractive for investors now to buy Japanese government bonds than US government bonds. But for now, the market is shaking it off. This is a very different response to what we saw in the UK at the end of 2022 and what we saw in France at the end of last year. Remember that at the end of 2022, then Prime Minister of the UK, Liz Truss, released her pro-growth budget based on unfunded tax cuts, which torpedoed the gilt market. Bond prices fell immediately and yields shot through the roof. It ultimately ended Liz Truss's career in just 45 days. Likewise, at the end of last year, French bonds offered higher yields than Greek bonds, as doubts grew about whether the French government could pass legislation to control spending. There could be a point where the Federal Reserve or Western central banks more generally are forced to intervene to hold down long-term rates. For now, though, uncertainty is being expressed via weakness in the US dollar. Most global investors are significantly overweight US dollar assets. 65% of the global index is in US equities because US stocks have been so strong. But today we still have this back and forth with tariffs, the potential of a ballooning deficit, geopolitical tensions, and investors have a lot of exposure to stocks and the US dollar as a result. At Antipodes, we're underweight the US dollar as we believe US exceptionalism is somewhat under attack from within the US, and it's quite likely that the US dollar has entered a structural bear market.
Europe also seems to be growing much more comfortable with fiscal stimulus too, and that shift was triggered by Trump. European equities have outperformed this calendar year. So could European stimulus be the catalyst that sees some rebalancing away from US equities to other parts of the world?
Yeah, so Trump's threats to pull defense spending away from Europe have seen the region respond aggressively with new programs around defense, security, and infrastructure. Germany, for example, has launched a $500 billion infrastructure package. This works out to be about 3% of GDP and could result in additional 2% of GDP growth as the program gets rolled out, not an insignificant amount. NATO is also lifting its long-term defense spending targets from 2 to 5% of GDP over the next decade. These programs won't deliver immediate results, but with the risks around tariffs remain, Europe's banking system is healthy and the ECB is cutting rates, which can further support domestic demand. The real win will be whether US protectionism ultimately hastens greater integration and pro-market reforms within the European bloc. Discussions around fiscal stimulus, the growth and opportunities it can create, and any risks around funding must be had in the context of where valuations are today. The issue with US equities is that they are priced at 21 times forward earnings. That's a 40% premium to their 20-year history. Europe, on the other hand, priced at 14 times earnings, is roughly in line with its long-term average. The point here is that Europe has much more fiscal headroom, an incrementally better growth outlook because of it's coming from a lower base, and then a greater margin of safety given the valuations we have.
Graham, let's turn to the portfolio. How are the global portfolios currently positioned?
The range of outcomes is clearly very wide here. So we don't want to become too bearish too soon. Tariffs have yet to be finalized, and the bond market may yet overlook the impact of those tariffs on deficit. But we expect leadership in global equities will broaden, both across regions, sectors, and styles. As fiscal capacity outside of the US gets deployed, real investment takes hold, and the AI thematic extends beyond the obvious enablers. The global long-only portfolio at Antipodes is roughly equally invested across what we call mature cyclical businesses, structural investment trends centered around cloud, AI monetization, and energy transition, and then defensive categories. Our mature cyclicals bucket, for example, is anchored around our exposure to developed world financials. French Bank Societe Generale is a great example of this. Net interest margins expanding as mortgages reprice higher and deposit costs fall with ECB rate cuts, plus excess capital to support buybacks and a hidden jewel in the ownership of a leading digital bank in France, we think is a very nice recipe. Priced at 7 times forward earnings, we think this is still a very attractive equity. We also have some exposure to energy and industrials, where the risk of recession is already priced in. For example, Airbus, a leader in commercial aerospace, is a market which is set to see many years of growth as the COVID-induced supply chain challenges are resolved, allowing deliveries to accelerate and into an underserved market. It's also Europe's largest defense business by revenue. And our China platform and property exposures like KE Holdings, China's leading real estate portal with close to 50% market share of secondary transactions, is set to benefit from any stimulus that we see in the Chinese property sector.
You mentioned structural growth trends. You called out cloud, AI monetization, and energy transition. How are you positioning for these longer-term winners?
Sure. I mean, cloud and AI monetization is really anchored around our positions in companies like Microsoft, Alphabet, and Amazon. In the case of Amazon, the largest hyperscaler and a key beneficiary of the AI investment cycle, they're also taking share in retail as well as online advertising. It's currently priced at a very significant discount to its own history, and by way of context, is now trading on a similar PE multiple to Walmart, but growing substantially faster. In terms of our energy transition exposures, we have companies like Johnson Controls, Siemens, Siemens Corp, and Siemens Energy. We've held Siemens for some time now, but it's a very well-positioned business for a broadening of the investment cycle, underpinned by things like onshoring, energy transition, as well as Europe's need to invest in its own infrastructure. We think it's growing underlying earnings in the low double-digit rate and priced at 18 times forward earnings. It does trade at a very significant discount to its global peer group.
And what about defensive assets? How are you balancing this exposure to cyclicals and structural growth areas, given the range of outcomes is wide?
Yeah, so we have about 35% of the portfolio in so-called defensive categories today. That's really anchored around areas such as infrastructure, healthcare, gold, defense is another example. And we've got about 10% of our exposure to infrastructure, including companies like RWE, which is a leading developer and owner of renewable power in Europe. More than 50% of its existing capacity will come from renewable energy sources over the next several years. We think that's an exciting prospect for both the valuations and the underlying profitability of the company. In addition to that, we've got another 10% or so in healthcare, including a leading hospital provider, HCA, which operates in the most attractive parts of the US landscape where we have population growth. It's priced at 12 times earnings with returns on capital in excess of 30%. We think it's a very attractive equity at this level. And then, things like gold continue to be well represented in the portfolio. Companies such as Barrick Gold and El Dorado. And more recently, we've been adding exposure to companies like Amplats, the platinum company out of South Africa. It's also worth adding that the global long-short strategy provides additional protection via single stock and tail risk hedges. So we have an underlying downside protection that comes with that portfolio, and we can remain very dynamic given the evolving macro landscape before us.
Thanks, Graham. It's always great to have you on the podcast to get your insights. For more details on Antipodes positioning and our macro views, check out our latest quarterly market update episode or the update video on our website, antipodes.com.
The content in this podcast is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives, or needs. You should seek professional advice before making any financial decisions. Stock commentary is illustrative only and not a recommendation to buy, hold, or sell any security.